Hey there, savvy investors and market enthusiasts. Welcome back to Market Matters Media. You clicked on this video because, like many of us, you're wondering about the big question. Are we heading towards a global economic meltdown? As the dawn of a new economic era emerges, powered by tech, green energy, and novel global partnerships, there's a looming shadow that has everyone, from Wall Street moguls to the small-time investor, a tad bit concerned. Imagine this, in a world that's more connected than ever before, the rise and fall of economies have become even more intertwined. The domino effect is no longer a game. It's a reality we all face. Countries rely on each other, technologies are independent, and one small change in a sector can ripple across the globe. If you've been keeping tabs on market trends, you've likely heard murmurings about inflation rates, changing monetary policies, and skyrocketing debt levels. In fact, some experts that these, combined with the unpredictability of a few key tech stocks, may be heralding the storm before the meltdown. Now, before we dive deeper, if you're finding value in this content, and I bet you are, don't forget to hit the subscribe button. It ensures you never miss out on insights like these. Let's dissect this piece by piece. First, the inflation rates. Global inflation has been on a steady rise, and while inflation isn't necessarily bad, unchecked and rampant inflation can spell disaster. High inflation rates erode purchasing power, create uncertainty, and can lead to reduced investments. Next, we have global debt. Since the 2008 financial crisis, global debt has soared to astronomical levels, exceeding 250% of the world's GDP. Governments around the world have been borrowing heavily, largely to fund stimulus packages amidst the COVID-19 pandemic. But what happens when these bills come due? Then there's the tech sector, the darling of the 21st century. Companies with valuations in the billions, sometimes without a penny in profit. Sounds familiar? Think back to the dot-com bubble. Are we setting ourselves for another bubble burst? It's not all gloom and doom though. There's a counter-argument. The growth we're seeing is sustainable. With tech becoming integrated into every aspect of our lives, its value isn't inflated, it's reflective. Green energy solutions are growing at an unprecedented rate. And while the initial investment is high, the long-term returns are promising. So where does this leave us? The answer is not straightforward. While there are significant concerns that we should be aware of, there are also reasons for optimism. As investors and market watchers, our goal should be to stay informed, diversify our portfolios, and never put all our eggs in one basket. In the face of such complexities, it's vital to consider the role of emerging markets. These economies, while traditionally viewed as high risk, offer substantial growth opportunities. As developed markets grapple with saturation and diminishing returns, places like Africa, Southeast Asia, and South America present untapped potential. From fintech solutions to Nigeria to e-commerce in Indonesia, the innovation brewing in these regions could play a crucial role in reshaping the global economic landscape. The next big thing might not emerge from Silicon Valley, but from the bustling streets of Bangalore or Lagos. Thus, a holistic view of the world market requires us not to focus on traditional economic powerhouses, but also to broaden our horizons and recognize the power of these emerging players. In this age of rapid technological advancements, economies are more interconnected than ever. But along with this progress comes a new set of challenges. One must wonder, with all the benefits, are we also paving the path to a potential financial abyss? Let's rewind for a moment. Post the 2008 financial crisis, global markets took a major hit. Institutions deemed too big to fail collapsed. But what brought us here? Excessive risk-taking, lack of transparency, and global financial securities. The world learned its lesson, or so we thought. Fast forward to today, and we see similar elements at play. First up, the inflation rates. Historically, inflation rates around 1 to 3% have been seen as manageable, even beneficial, stimulating spending rather than saving. But as reports flood in, we're seeing rates climb in significant economies around the world. The US alone reported a jump to a 13-year high in mid-2021. When prices soar, the consumer's purchasing power shrinks. This could lead to a reduction in consumer spending, which in many countries is a backbone of the economy. And there's the giant elephant in the room: global debt. Remember when the US national debt clock was making headlines? As of now, global debt has surpassed $281 trillion, an unprecedented 355% of the world's GDP. You might wonder, who do we owe this money to? The answer is complicated: other countries, international bodies, and even our future selves. Debts can be beneficial, funding infrastructure and growth. But excessive borrowing without a clear path of repayment or growth can lead to long-term financial instability. Then there's our beloved tech sector, the Silicon Valley darlings, the unicorns, and the emerging startups. Remember companies like Pets.com from the dot-com era? Valued at billions and then, poof, vanished. Today, companies like Tesla have valuations exceeding that of traditional giants like Ford and General Motors combined, even when their car production is a fraction. The question remains, are these valuations a sign of a brighter future or an inflated bubble waiting to burst? Still, it's not all red flags. Many argue that the current growth, especially in the tech sector, is sustainable. The counter-argument is compelling. Artificial intelligence, machine learning, and quantum computing are not just buzzwords. They're revolutionary technologies expected to reshape our world. Companies pioneering in these fields might just justify their skyrocketing valuations. Moreover, with the aggressive push towards green energy and sustainable solutions, industries are emerging that promise not just economic, but environmental returns. And this is where the opportunity lies. Despite the potential risks, if navigated wisely, this era could be golden for savvy investors. Think of the internet boom. Many lost, but those who invested wisely in companies like Amazon or Google reaped unimaginable rewards. Our current situation is similar. While some tech companies may be overvalued, others could be the gold mines of tomorrow. Here's some advice: stay vigilant. Continuously educate yourself. Don't be swayed by market hysteria, either optimistic or pessimistic. Markets are driven by numbers, yes, but also by emotions. A balanced, well-researched approach can shield you from potential pitfalls. To wrap up the future, as always, remain shrouded in uncertainty. Economies may rise, bubbles may burst, but opportunities always linger on the horizon. Every economic downturn in history has been followed by a resurgence, and there's no reason to believe this time would be any different. So whether you're an investor, a student, or just someone keen on understanding the complex world of global economics, remember, the market always matters. It's not about predicting the future, it's about being prepared for it. Thank you for tuning into Market Matters Media. If you found this deep dive insightful, show us some love. Hit that like button and subscribe for more deep dives into the ever-evolving world of economics and finance.